Opportunities in equities and the power of markets on this week's edition of WealthWise. Hey, I'm Clark Holt with Elevate Wealth Advisory. Let's look at what this means for you. When we look at the world of investing and the investing landscape, we prefer to look at countries by market capitalization. What is market capitalization? It's simply the number of shares outstanding for a company multiplied by the share price. And we prefer to use that metric when we're looking at the investing landscape to build global portfolios. When we look at the global market landscape, we have to look around the world at each country's market capitalization. This is very important when building portfolios. Right now, the world market capitalization is about $72 trillion. The United States represents about 57% of that. For example, other countries, Japan is 7%, Australia is 2%, Canada is 3%, the United Kingdom is 4%. So we want to be invested not only in the US, but outside the US to capture the returns around the world. When we talk about the US market, we often talk about the S&P 500. And the S&P 500 is a proxy for our US market. It's 500 US stocks. But what a lot of people don't realize is that the S&P 500 is market cap weighted. And what that means is it's the number of shares outstanding for a company multiplied by the share price. As of today, 6 companies represent about 24% of the S&P 500. And that's Apple, Microsoft, Amazon, Facebook, Tesla, companies like this. And what this means is they have a major influence on the performance of the S&P 500, whether that be to the upside or to the downside. So keeping this in mind helps give us perspective as we go through different market cycles. And we certainly want to be invested in the S&P 500, but we also want to have exposure to all those other companies that are in that index. When we look at the S&P 500 index and we want to look at the performance, it's important to look at calendar year returns as well to put things in perspective. So if we take a look at January 1980 all the way through December of 2020, the S&P 500 return was a little over 11%. However, every calendar year for that period, there was a decline intra-year or during the year, sometimes significant declines. This is important to understand as we go through market cycles. And when we take a look at this time period, out of 41 years, the S&P was positive 34 years. So knowing that gives us confidence, it gives us discipline, and it helps us stay the course. Reacting to the markets can hurt our performance. It can deteriorate wealth. And so we want to stay the course. We want to stay invested and stick to our plan. So when you look at things like the US market, for example, if you invest $1,000 in the US market or the S&P 500 in 1991 and you stay invested that whole time, your ending value is $21,000. However, if you miss just the best year during that period, your ending value is a little over $12,000. So it's very important to stay invested and not have knee-jerk reactions along the way based on volatility, market declines, economic policies, things like that. We also want to look beyond large cap developed US markets. We want to look at not just large cap US, but small company US. We want to look at non-US developed markets. We want to look at emerging markets. We want to look at real estate. And if we take a look at the decade of the 2000s, the 10-year period for the S&P 500 actually was a negative return. But outside the US, there were major returns for the taking. And so having a diversified portfolio helps balance out the different returns that are coming from around the world so we capture the returns that are there. Whether that be US small, international large developed, or real estate. That's it for this edition of WealthWise. I hope you found this information on the power of markets and equities insightful. Please join us next time on WealthWise.